Ba-dum, ba-dum, bum, bum. Let's do it, folks. Good morning, one and all. Welcome to the street today here from Post 35 on the floor of the NYSE. I know you're thinking that has to be a green screen behind him. No, it's the real deal. Today is Wednesday, the 22nd of February. Somehow, already, it's almost March. I'm your host, JD Durkin. That's what the box says. We're about an hour or so into trading, and markets are now down. They were up, then down, as investors await minutes from the FOMC's February meeting. On the show this morning, let's take a look for what's on tap. We will talk markets as stocks come off their biggest single-day decline of the year. Yeah, yesterday was not a pretty one. Plus, we'll talk Fed as investors eagerly await minutes from the central bank, eagerly await. And finally, we dig into Coinbase after the company's Q4 earnings. For more on those stories and so much more, we welcome back in our senior editor, our chief markets correspondent, Mr. Martin Baccardax. Hi, Martin. Good morning.
Good morning, mate. How are you going?
I'm doing all right, my man. I can't say the same necessarily for all of the major market indexes, at least yesterday. How do you think we should approach today's session one day after the worst day for stocks, at least so far, in 2023?
Yeah, we're not going to climb out of the worst day of the year very quickly, JD, and I'm not surprised that we've turned red sort of after that modestly positive start. I mean, the VIX index is what I'm really paying attention to and have been for the past couple of days alongside Treasury bond yields as well. But the VIX is probably the principal volatility gauge that investors look to when they want to understand how significantly markets are likely to move on any given day. That volatility index is up about 30% since the start of the year and trading around 23.5 points. Now, there's some arithmetic involved in this, but essentially that means that traders are anticipating a 1.4% swing for the S&P 500 on any given day over the next 30 days. That translates to around 58 to 60 points on either side. So again, it's not surprising that we went green, and certainly on a fundamental basis, not surprised that we're in the red right now. We are looking at the potential for an earnings recession. We are looking at Fed rate bets accelerating to the point now where we see about a 5.375 terminal Fed funds rate by the beginning of the summer. We're also seeing 10-year Treasury yields rise as well, which I mentioned. And again, there is some concern that the January economic data is simply not strong enough to last into the first half of the year, and we're staring at recession over the back. All of that's combining to put pressure on stocks today, and was certainly a big portion of the reason that we had that big decline yesterday.
So let's do a little bull versus bear debate. Martin, I'm going to ask you to put both hats on. We'll start with the bulls. If you are a bull in this particular market, A, good luck. B, what do you as a bull have to be optimistic about regarding the current environment?
See, that's a great question, JD. Maybe we can draw some boxing analogies. I mean, if I were a heavyweight and I was still standing after taking haymaker after haymaker from Mike Tyson, then I might be bullish that I'll at least last the 15 rounds. And the markets have taken a series of haymakers from the Fed, particularly at the end of last year, in the form of those 75 basis point rate hikes. And they're still standing. And not only are they still standing, but the economy is holding up as well. 517,000 new jobs in the month of January. Retail sales had their best monthly gain in over 2 years. Economic activity indices are showing resilience from a corporate point of view. And the globe is going to get a benefit from the China reopening. So if you could argue that the market and the economy has been able to withstand those series of punches from the Fed, maybe you could make a bullish case.
And now if you're not a bull, if you're a bear, as things stand, it might be a longer answer.
It might be a longer answer.
What's driving your optimism these days? Yeah.
Well, not very much. You might be thinking that whilst the economy is on its feet, its knees are wobbling, JD, and we are looking at the potential for that earnings recession. And by that, I mean corporate profitability is going to decline for 2 consecutive quarters. It's certainly declining over the fourth quarter. In fact, the anticipation is that once you strip away the energy sector, the corporate profits for the S&P 500 are going to fall by around 7%. That number is going to accelerate even further over the first 3 months of this year. And stocks are historically expensive. The forward price to earnings ratio is around 18 times, and that's a little bit higher than the standard long-term average. So you have expensive stocks, reduced profitability, rising interest rates, and the potential for recession. So whilst you could make a bullish case, I do think that you're about to hit the mat relatively soon, and that's really what's being reflected in stocks and probably why the bearish thesis is going to win the day.
Are you a boxing fan, Martin? Sounds like
The
you are.
sweet science. I'm a very, very old school boxing fan, and part of the reason was it was my father's first and favorite sport. So I had to endure these fights as a child of the 70s and 80s, irrespective of whether or not I enjoyed them or not. But I ended up having a great respect for the sport. I'm not an MMA guy. I'm really just a pure boxing fan, if only for the athleticism. But I have lost touch, I have to say, over the past few years.
You went from having to endure it to now being able to use it as a great description for what happens in the markets and a great bull versus bear debate, so I appreciate that. Anytime we talk markets, the conversation, of course, needs to more or less start with the Fed. We will get those minutes out later on today. We already know the answer.
Yeah.
It's kind of like it's like when you do homework and you got to show the answer, but you also got to show your teacher how you got to the answer, like show your work. Right? It's like we already got the final answer, 25 basis points, great, but now we want to see the work, want to see how we got there. What new information, Martin, can we learn about the February FOMC decision and the meeting?
Now, that's an excellent description, JD. The Fed absolutely has to show its work for that interest rate decision. It was, of course, the 8th in a row, and it took the Fed funds rate to the current level of 4.25% to 4.5%. I think now, though, JD, while typically the Fed minutes are backward looking, some of the commentary from Fed officials that basically advanced the case for a 50 basis point rate hike in February are now being reflected in bets on what will happen in March. Therefore, investors, traders, and everyone else are going to search through the minutes for Easter eggs effectively that sort of find how strong that case was and discover whether it has momentum and support to establish itself again for that March meeting. Now, the CME Group Fed Watch, which we talk about quite often, pegs the chances of a 50 basis point rate hike at about 20%. Now, that may seem small, but when you consider that only a month ago it was absolutely zero, there was no one making that bet whatsoever, that's an enormous change with respect to potential Fed forecasts. So it puts the minutes in a very different context than it normally would be. Loretta Mester has talked about the case for a 50 basis point hike. James Bullard has made sort of a similar arguments. Neither are voting members, and I think that's an important context to place their comments into, but nonetheless, they do influence their other colleagues, and as a result, we are seeing those bets creep forward, and I think that's why the Fed minutes today, JD, have a slightly sort of different resonance for the market than they might typically have.
What do we know about what goes into that CME Group Fed Watch number, right? Because obviously we've gotten those comments from the Cleveland Fed president and the St. Louis Fed president, the two aforementioned names, Mester and Bullard that you just talked about, despite the fact that they're not voting members. You know, the idea of 21, I think it's 20% chance, which was kind of unthinkable a few weeks ago, is now based on what? Is it based on data, or is it based on a little bit of the jawboning that you get from the hawkish members, even if they're not voting members?
Well, the interest rate data will, of course, reflect what people are hearing from Fed policymakers, but ultimately the data itself reflects trading points in interest rate swap markets and in other interest rate derivatives, which then are translated into this percentage chance of either a 25 basis point rate hike, 50 basis point, what have you. And the Fed Watch tracks these not only for the coming meeting, but for meetings heading into the end of the year and into the start of next year. And it's interesting, JD, in that context, when you talk about things that were unthinkable just a few weeks ago, certainly now we are talking about, if not 50, at least 3 hikes of 25 basis points between now and June. Now, previously, there wasn't any indication we would have a hike in June. The chances of that now have leapt past 55%. So essentially, the smart money now says that we'll get 3 more hikes, take the Fed funds rate to between 5.25% and 5.5%. And actually, we're seeing even creeping indications, JD, that we could get a 4th rate hike. The number is very small right now, and it's not significant in terms of market direction. But nonetheless, the underlying significance of it, I think, is important. And it's a big part of the reason why we're seeing that notable push higher in Treasury bond yields.
To the point about the February minutes. The meeting took place 3 weeks ago. We got a lot of data since then that shows that we got a pretty healthy economy, including that blockbuster 517 jobs number, which I know time's a flat circle, nothing makes sense. We forget what came before what, but we did get the policy meeting decision before the 517 figure. I think it's a good faith question. A lot of people are going to wonder, are the minutes already outdated?
To some degree, yes, but ultimately, I think the thought process is just as important as how closely the Fed minutes will reflect recent data. And I say that because Chairman Powell's long-term assessment has been that the economy is resilient enough, particularly in the labor market, to withstand the impacts of these rate hikes. And the reason he can say that, or at least attempt to advance that argument, is that he can justify these big rate increases by saying, listen, it hasn't really had an enormous and damaging impact on the labor market. Loads of people haven't lost their jobs as a result of what we're doing to fight inflation. And therefore, that probably puts us on the correct path going forward. If the economy can somehow manage to hold on to jobs gains whilst taming inflation at the same time, then you can get towards, JD, this sort of ephemeral concept of a no landing scenario, not a hard landing in which the economy has to slip into recession in order to tame inflation, not a soft landing where growth slows notably but doesn't tip into recession, but the no landing where the sort of like growth trajectory can continue escalating ever so slightly whilst at the same time cooling inflation and establishing resilient gains in the job market. There's many people who are advancing that argument right now. Stocks have mostly reflected it. They're coming under pressure in recent days, of course, but nonetheless, if you were to get that no landing scenario, then stocks would look incredibly cheap at their current valuations, because that would assume that corporate profitability would accelerate significantly into the second half of next year. So all of that together, JD, is another reason why I think the minutes become so important in today's market context.
It's amazing because now the phrase no landing is seemingly everywhere. I think you were the first person I heard it from last week, or maybe the week before. No. Well, listen, if you wanted credit for it, I was willing to give you credit for it, but I've heard it everywhere. I was on another network, and it's coming up in every conversation now, and that's kind of the way that's kind of an interesting phenomenon, I think. And it happens in political news, but I notice it happens a lot more in business, financial news, is that because so much of what we do is kind of rhetoric driven, there do become newly planted seeds of ideas that just tend to take off. And I wonder, in your experience, if that phenomenon is it a good thing, is it a bad thing, or is it kind of somewhere in the middle? Because it's not always a good thing if everyone starts to latch on. I'm not saying that's what you're doing by any means, because we needed that context. But it kind of seems like once you got one prominent voice starts to throw something out there, a lot of people very quickly kind of latch onto it.
I mean, it is the challenge of financial market reporting and indeed commentary, JD. It takes several beats to be able to explain a concept with any great clarity. That's very different from most sort of like sections of the news, which you can explain in very short and very sort of, I won't say synthetic, but targeted sound bites. You can't really do that in financial markets because everything is predicated on the movements of other things, and it takes time to explain. Now, to a secondary degree, I take your point, because financial markets have, for the longest time, hid behind jargon and acronyms in order to sort of almost create this illusion that understanding financial markets and economics is a kind of black art that only the most sophisticated and educated are able to do. That's absolutely not the case. There's not much more than simple algebra most of us need to understand to really get our hands around what is happening in financial markets. You don't need these advanced mathematics, not today. And you really don't need the kind of decades-long experience that many people say you need to acquire in order to get the full understanding. But as a result, because people do tend to either hide behind acronyms or potentially use them in sort of replacement of full understanding, they take on meanings of their own. So I think your point is a good one. It isn't always the best way to share this information through sound bites that don't have a full and complete understanding, and no landing is absolutely one of them.
Yeah, and there's obviously a difference, because this time last year, or maybe slightly before, we take our cues from officials. So when they say
Yeah.
it's transitory, everyone says inflation's transitory. It's just transitory. That's what the Fed says. And then that word transitory appears everywhere. And now transitory is kind of an open joke in the world of financial markets. Like, oh, remember once upon a time when they said it was transitory? Okay, so real quick here, remind us your expectation for the terminal. You said it's going to be around 5.3, 5.4 ish.
Yeah, 5.25 to 5.5% will be the targeted range. But of course, in that range, there's quite a lot of movement. The Fed essentially tries to defend that target range with a whole host of its operations. It's a large part of the reason why it's called the Open Markets Committee, because the Fed has to be tasked with holding that base rate in place, either through purchases or sales of securities or a whole host of sort of other mechanics. Now, we are starting to see that creep a little bit higher within the band. In other words, whilst the terminal Fed funds rate will be between 5.25% and 5.5% based on current market assumptions, within that band, we're creeping a little bit higher to about 5.375%. Now, that is a little bit more than maybe the 5.28, 5.29% that I was looking at last week. And again, JD, that's probably why we're seeing, again, very small, but nonetheless noteworthy bets on a fourth rate hike between now and the end of the year. And again, how different is that to the beginning of the year when there was significant discussion about rate cuts?
Martin, you and I have previously discussed what you do to celebrate Fed decision days. I know Wednesday is big for your local grocery store in terms of items you like to get. Is there a certain tradition you have for minutes days? Admittedly, not, we're not on the edge of our seat here eagerly awaiting a number, but do you get a little special tradition you're willing to share with us for Fed minutes days,
really
or is it just not?
No, you know what? I haven't established a Fed minutes tradition just yet, JD, but I think it's worth consideration. I think now I really like this analogy that you drew about showing your work. So maybe there's some way that I can complete that full circle and come up with a tradition that sort of reflects that, because I think that's an excellent way to describe it.
Yeah, it's just honestly, it's my sophomore geometry teacher, Coach Allen. It's still in my head. I mean, it's almost as if the answer were less important than making sure you were diligent about showing how you got there. And that's of course many years ago, but it's first thing that popped into my head.
It's still valid. It's still profound. It separates understanding from mere reflection, and I think that's probably the most important aspect of Fed minutes.
Yeah, imagine if Mr. Powell just simply came out and goes, "All right, it's 25. I'll see you in 6 weeks," and then walked off the podium, right? I mean, that's not what we want. That's it. See ya. No time for questions, folks. Yeah, exactly. Okay, so let me ask you finally, anything else FOMC, central bank, voting members concerned before we pivot over to NVIDIA? I want to give you the opportunity to underscore anything we did not get to already discuss.
I think the only thing, JD, and we did allude to it, but I think it's worth repeating, is what we are seeing in the bond market. 10-year Treasury bond yields are trading at about 3.95%. Now, that's the highest since early November. I think stock investors really need to pay attention to that number, because if it climbs past 4%, and there's every chance it could do that either this afternoon or into the end of the week, that's going to have a significant, and I do want to repeat that, significant impact on stock valuations, or at least near-term market moves. We've seen big analysts from Morgan Stanley, from JP Morgan, and indeed Bank of America all saying that the S&P 500 is vulnerable to a big drawdown over the next 3 to 6 weeks. The numbers, of course, differ quite significantly, but nonetheless, one of the worst case scenarios is a 26% drawdown for the S&P 500 from its current levels between now and sometime in late March. Much of that is going to be predicated on how quickly tends past that 4% mark and how long they stay above it. So really do pay attention to that if you are an investor whose sort of positioning is predicated on S&P 500 direction, because it will be very important for that.
All right, let's talk NVIDIA. We got those earnings coming up after the bell today. What are analysts expecting from the chip maker, especially as it pertains to gaming revenue? Gaming was one of the big stories during the pandemic. Everyone's stuck at home, and our habits have changed a little bit. And I think the expectation, at least to some degree, is we'll probably see that reflected here today, won't we?
Yeah, absolutely. They warned on that really quite early, JD. And again, it's a great example of how NVIDIA sort of manages expectations and speaks to the market. And a big reason why Jensen Huang and that company have such great respect and have been really one of the outstanding performers this year. They talked about the impact of the pullback in gaming spending. We've seen it articulated from Take-Two to Activision to Microsoft and pretty much everyone else. So we don't anticipate a big change in terms of what we anticipate for gaming revenues, not only for the fourth quarter, but indeed going into the coming fiscal year, which began on the 1st of February. But the data center portion of NVIDIA's story is probably the most compelling at this stage, JD, because it incorporates this spending surge that we anticipate we're going to see in AI. The Microsoft and Google, of course, are locked in this arms race about embedding that generative AI into their search engines. Microsoft Bing is trying to expand that chat GPT and steal a great portion of the market share that Google has hammerlock on. And both companies really purchase chips from NVIDIA. So it stands to win regardless of who comes out on top of this new race to become the AI leader. NVIDIA is really the world's foremost developer of these chips, and they have a significant lead on a lot of the rivals. IBM has been in the AI business for a number of years, but hasn't really captured the sort of zeitgeist in the way that NVIDIA has because it's executed so well. So data center revenues, JD, which make up the bulk of the top line for NVIDIA, will be very closely watched. The anticipation is the forecast for this year is that they'll grow 20% year on year. That's obviously an excellent reflection of the company, but I think more people are going to be looking at what NVIDIA says about their AI suite of chips. They have a new one coming out in the coming weeks. Potentially, they'll talk about it in the earnings call this evening. It's called Grace, and it's meant to be sort of the leading edge, which a lot of the companies that we talked about, Microsoft, Google, and others, are going to be using in their AI infrastructures.
Even if the stock, and I'm pulling up here, is still up 43, almost 44% year to date, it is still down 25% from its 52-week high. And that would be about the end of March or so last year when it was trading at about 286. The stock's currently at about 205 and change. What are some of the other biggest headwinds you think NVIDIA is currently facing?
The China reopening and sort of the uneven nature of that, JD, is probably the most significant because it sort of speaks to what you alluded to with regards to gaming demand. China is, of course, has always been at the forefront of gaming demand, and NVIDIA has capitalized on that. But we don't precisely know to what degree that demand is going to return as a result of the reopening or indeed fade, because we saw gaming demand fade a little bit after the COVID pandemic in most Western markets. U.S. restrictions on high-tech exports to China as well have been a headwind for NVIDIA, but it's been able to sort of fine-tune that a little bit by replacing one of its higher intelligence chips with one that isn't quite as sophisticated, but does essentially the same thing. So they've been able to protect some of that lost revenue, but nonetheless, it remains a headwind, particularly when you're looking at trade relations between Washington and Beijing that appear to be eroding sort of by the day. So any company that has exposure to there is going to be perceived to be at risk by investors, no question. So those are the couple of things that I'll be looking forward to. And I think ultimately, JD, as well, NVIDIA's toehold in the automotive chip space is also interesting. They signed a deal with Foxconn late last year in which a series of NVIDIA chips are going to be embedded into an autonomous driving platform. That has the potential to be really interesting and a great driver of revenue growth. The numbers are quite small, but the gains in terms of percentage year on year have been very significant for NVIDIA. So it has the potential to be a really important driver of growth for that company in the coming years as well.
And to that point about Washington and Beijing, you're talking about a real chipping away of geopolitical tensions or an underscoring of geopolitical tensions as we now have headlines with regards to Beijing and Moscow in light of President Biden's trip to Ukraine here in recent days. That is a storyline that certainly many in the corporate world will have their eyes on. We're seeing a bit of an AI arms race play itself out. Names like Microsoft and Google betting big on the technology. Obviously, everywhere you turn, you got a chat GPT related headline. How can NVIDIA maybe make advances in that space? How does NVIDIA better fit? I know you're alluding to it there a moment ago, but AI is everywhere, Martin, whether or not we want it to
Yeah.
be. Ugh.
These guys, they're the market leaders in these chips and have been for a number of years now. IBM, of course, has a long history of it, but hasn't been able to execute in the way that NVIDIA has. And they are developing new chips, I'm not saying every day, but they're certainly well in advance in a new chip called Grace, which is going to be very important for the Microsoft and Google developments. I know that a lot of the headlines have been very sort of derisory with regards to what AI can bring to the search engine business, and certainly the Chat GPT stuff that we saw reported in the New York Times last week was undoubtedly disturbing. There's no question about it. But that doesn't mean the technology is going to go away. If there's one thing that big tech has taught us, is that they are going to move quickly with the advance of these technologies, and they are going to bring them into their daily operations, whether we like them or not. So I am certain that AI is going to play an enormously important, if not the most important, element in search over the next few years. That's important to NVIDIA, but it's also important to us as users of these sort of big tech architectures, because our complaints are going to fall on deaf ears. If AI can deliver things in a more efficient manner, the sort of substantive arguments against its use are going to fade away, and we're just going to have to live with it.
Absolutely. All right, fourth quarter earnings is wrapping up as we know it. What are your takeaways so far? Most of the way through? Is it a meh? Somewhere in the middle?
I think it's I keep the number of financial commentators who have said that the earnings season isn't that bad is mystifying to me, because I don't think this earnings season has been particularly good in any sense of the word. We are looking at collective S&P 500 profits falling about 7% from prior year levels, and that number is going to accelerate further into the first 3 months of this year. So, irrespective of the fact that, whether or not you believe in the fact of an earnings recession, I simply don't see the resilience in corporate profits, particularly at the techs, sort of in the tech sector, that a lot of people have been using to underpin their logic for the solid stock market gains that we've witnessed so far this year. If they're looking for it, they're not going to find it. And I really think that what we saw from Home Depot and Walmart yesterday, in which they not only cautioned on the level of consumer spending or lack thereof, but also said that their cost base are going to continue to rise and therefore compress margins further. That's a warning, I think, that a lot of companies are going to have to heed. And if not, certainly a lot of investors will have to.
Martin, we've been doing the show long enough for you to know that I don't like to ask you something you're not prepared to talk about, but there is a little bit of breaking news, and I do want to ask you, it has to do with the world of tech layoffs, and I'm hoping you're willing to weigh in. The headline out of the Washington Post is Meta plans to cut thousands of jobs after the CEO predicted no more layoffs. The subheadline is the Facebook parent company plans to push some leaders into lower level roles, flattening layers of management at the social media giant. And the job eliminations arrive after Mark Zuckerberg sought to reassure workers that he did not anticipate more layoffs after the company already slashed 11,000 jobs, or about 13% of its workforce, back in November. Obviously, Martin, whenever we have companies like this, the Googles, the Microsofts, the Amazons, now the Metas of the world, they're going to earn outsized attention because of the scale and scope of who they are. This has led many to wonder if it's a bit more of a tech session, at least right now, as opposed to a regular recession. But give me your sense as you continue to see headlines like this, especially for a lot of these companies that, as we know, hired a lot of workers in 2020 when other parts of the economy were forced to slash workers.
Yeah, I'd want to see the nature of the layoffs in terms of whether or not they would sort of encompass early retirements or people who were just sort of encouraged to maybe take a package and walk out the door, versus those who are losing their jobs involuntarily, and to what degree there might be some double counting, because the 11,000 job cuts are still, for the most part, ongoing. So I'd wonder how those were separated from the previous numbers to the current ones. And that's not to question the the Washington Post reporting, but just to say I'd want a cleaner context in which to evaluate these new potential job cuts. But there's no question Meta is facing a couple of conditions which I think make it unique to a lot of its peers. Firstly, Meta is really an advertising-driven company, and we know that digital advertising spending is on a significant pullback, certainly in the first quarter and potentially throughout the whole of 2023. Companies are cutting their marketing spend. There's no way they can advance marketing spending when they're laying off people, and there's no way they're going to do that if they see a recession looming over the second half of the year. And secondarily, with respect to Meta, they are, of course, bleeding red ink in that metaverse division, which Zuckerberg has said he's going to continue to invest in because he sees it as potentially the future of the company. To generate profit and to expand margins. The metaverse is a very long way from even us understanding what it is conceptually, let alone generating a profit. That probably explains why Meta is looking at deeper job cuts. It also probably explains why it's trying to roll out this subscription, this verified subscription process, which I think is just perfectly ridiculous. I can imagine maybe why some companies which are advertising their goods and services on Facebook would want to have it. I can't possibly see a reason why an individual user would want to pay Facebook for the privilege of verifying their own identity after having already handed over all of the data that verifies their identity in the first place and being told by Facebook in its actions and words that they didn't care about its probity in the first place. That's an absolute non-starter, but it does, again, sort of indicate that Facebook is facing significant headwinds and is looking for all sorts of ways in order to manage them.
Absolutely. Well, thank you for that, Martin. Again, to be able to touch on a bit of breaking or developing news is always welcomed on the show.
Always fun.
And so thank you to you and our producer, Rebecca, as well for flagging that. Okay, time now for our rapid fire section. I do want to kick things off with Intel. That name slashing its dividend payment to the lowest level in 16 years. If you just read it, it's not a lot of a dividend payment. What's going on here?
Yeah, they've cut it by 65%, JD, to 12.5 cents. They alluded to this a few weeks ago when they issued a really grim 2023 forecast and of course had weaker than expected fourth quarter earnings on the back of it. They said they wanted the dividend to be competitive, but didn't commit at the time to maintaining the payout ratio. So I don't think anyone was terribly surprised this morning, although those that sort of depend on it for income are nonetheless going to be suffering. Intel's trying to preserve its capital for some of the big spending initiatives that it has planned over the next few years and attempting to, along with the U.S. government, bring the chip sector and the foundry business back to the United States. So as a result, it probably was left with little choice but to do that. But that's never a popular decision and puts tremendous pressure on Pat Gelsinger, the Intel CEO, to deliver near term on those commitments, because you cannot fail after you've cut the dividend. If you do, generally, the board is going to show you the door shortly after.
Absolutely. Okay, let's talk Coinbase next up. That company's slumping after reporting Q4 earnings. What did we learn from Coinbase, Martin?
We learned that Coinbase is very susceptible to downturns in the Bitcoin market. We're looking at trading volumes that are down about 75% on a year-on-year basis. The number is even worse when you look at retail trading volumes, JD. They were down 90% from year-ago levels, and that's just astonishing. So we saw a big decline in overall revenue, $605 million, and a $557 million operating loss. Now, higher interest rates mean that its subscription services were able to generate a bit more revenue than analysts were expecting, and that's probably going to continue into the first quarter of this year. But absent a real and significant comeback for cryptocurrency markets, Coinbase is going to have to operate at a very different level than it has over the past couple of years, and that's going to manifest itself into a big reset the stock price. Coinbase is trying to do the right things. It's trying to operate within both the letter and the spirit of current regulations, but the FTX collapse has had a big impact on broader currency markets, broader cryptocurrency markets, and Coinbase was just unable to avoid that.
Absolutely. Okay, number 3, Palo Alto. Big story of the morning, surging after an earnings beat. Does the company have S&P 500 potential?
It really does, JD. Essentially, what you have to have for consideration for inclusion into the benchmark is 4 consecutive quarters of profitability. Palo Alto published its third with its second quarter earnings last night, and they anticipate to do so in the current 3-month period. So I think the chances of it coming into the S&P 500 by the summertime are very, very good. It will probably be September before it begins trading, but nonetheless, the prospects are excellent. I think his market value is somewhere in the region of $56 billion, but tracking funds will need to buy the stock in order to mimic the representation, and that'll put a big tailwind under the share price if indeed this is confirmed. But Palo Alto is an interesting company. It's involved in the cybersecurity space, and it's one of the most respected names. And what they are indicating with respect to their bullish near-term outlook is that corporate spending may be pulling back on cloud and marketing and sort of other digital services, but not in cybersecurity, because of course the conditions are so extreme and the risks are so high that they can't afford to scrimp at that level. So Palo Alto is capitalizing on that, and shareholders who've been in the stock for a long time are likely to do so as well, particularly if it joins the benchmark later this year.
And that, folks, is why we call him best in the biz Baccardax. Actually, I'll be honest, I've never called you that before, but I might start doing that. I might start doing that and see if it catches on, because in a show like today, Martin, we had everything you need to know and a bit of breaking news as well for all the context and perspective that I think is really important to our viewers and our readers. The great Martin Baccardax, thank you as always, my friend. We'll do it again soon.
Thanks, JD.
All right, folks, and that is going to do it for The Street today. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.